You know, in the world of high-stakes finance, numbers are supposed to tell a story of success, of growth, of stability. But every now and then, they tell a very different kind of story, one about deception and intrigue and massive crime. A story that starts with a number so big it just doesn't seem real. 1.9 billion euros. That's the staggering amount of cash a huge German tech company, Wirecard, claimed was just sitting there in trust accounts. I mean, this was the bedrock of their whole valuation, the ultimate proof of their amazing success. And then the bomb dropped. Auditors finally confirmed that the money, all 1.9 billion of it, didn't exist. It had never existed. It was nothing more than a ghost on a balance sheet. So, let's really get into this, because that's the mystery at the heart of it all, right? How does a sum of money that big, a number that a whole company depends on, just evaporate? Well, the simple answer is it doesn't. It was never there in the first place. So the real question is, how on earth do you prove it?
We are talking about a full-blown digital crime scene here. The evidence isn't fingerprints or fiber samples, it's data. And digging through it to find the truth, that takes a whole new kind of investigator.
So who are these investigators? Well, meet the forensic accountant. Now, this is not your everyday run-of-the-mill auditor. Think of them more like a digital bloodhound, trained specifically to sniff out lies in a massive jungle of data.
It really all comes down to a completely different mindset. You see, a traditional auditor looks at a financial statement and asks, are these numbers fairly presented? Basically, did they follow the rules? But the forensic accountant, they look at the very same numbers and ask a much, much deeper question. What's the real story here? What are these numbers trying to hide?
And this entire approach, this way of thinking has a name: professional skepticism. It's the absolute core of what they do. It means you start from a place of doubt. You don't trust the report, you challenge it. You assume something is wrong until you can prove without a shadow of a doubt that it's right. It is literally the opposite of a normal audit. You know, massive fraud like this doesn't just happen in a vacuum. Investigators have this framework they use called the fraud triangle. They're looking for 3 key conditions. First, there's pressure, some kind of motive, like an insane pressure to hit a stock price. Second, there's opportunity, a crack in the system, a weakness they can exploit. And finally, there's rationalization, the little story they tell themselves to make it okay. When you find all 3 of those things together, you've got the perfect storm for a major crime. So how do they actually find the crime? Well, today's digital detectives come armed with a serious high-tech toolkit. We're talking powerful algorithms that can sift through mountains and mountains of data, all just to find that one tiny clue that blows the whole case wide open. Okay, now this is where things get really, really cool. One of the most elegant and honestly kind of mind-blowing tools they use is something called Benford's Law. It might sound complicated, but the idea behind it is pure genius. It's basically a law of nature for numbers. It turns out that in almost any naturally occurring set of numbers, we're talking everything from stock prices to the length of rivers to invoice amounts, the number 1 shows up as the first digit about 30% of the time. The number 2's next, then 3, all the way down to the number 9, which shows up less than 5% of the time. It's this bizarre but totally predictable pattern that's just everywhere in nature. Now, here's the magic trick. When people sit down and just invent numbers to commit fraud, they almost never follow this natural pattern. Our brains subconsciously try to make the numbers look random, so we spread out the first digits pretty evenly. So when a forensic accountant runs a Benford's test and sees a flat, uniform line instead of that natural downward curve, bam, that is a massive, flashing red flag. It's the data itself screaming that a human hand has been messing with the books. And the toolkit doesn't stop with Benford's Law. Not even close. Artificial intelligence is an absolute game changer. AI algorithms can spot anomalies that no human ever would, like a $1 million payment being processed at 3 a.m. on a Sunday. They can create these incredible visualizations that map out how money is moving to spot phony circular schemes. They can even use something called natural language processing to scan company reports for subtle shifts in tone that might indicate deception. It's incredible stuff. So that's the tech. But how does this all work in the real world? Well, let's go back to our 1.9 billion euro mystery, because this is exactly how investigators finally cracked the Wirecard case. It wasn't about finding a forged signature in a dusty ledger. It was all about cracking a digital code. And here it is.
the smoking gun. Wirecard claimed a huge chunk of its revenue was coming from these mysterious third-party partners over in Asia. But when investigators aimed their data analytics tools at them, they found something just stunning. These partner companies, these businesses that were supposedly processing billions of euros, had no digital footprint. Zero web traffic. They were ghost companies. The data proved it was impossible for them to be generating any real money. The cash was a complete fantasy.
Now, uncovering the fraud is one thing, but making it stick in a court of law? That's a whole other ballgame. And that's why the digital detective's work is backed up by a really powerful legal framework. This is what gives the whole investigation its teeth. So, you've got laws like Sarbanes-Oxley, which means CEOs and CFOs have to personally sign their names to the financial reports. The "I didn't know" defense, it just doesn't fly. Auditors can be held legally responsible for willful blindness. That's a fancy way of saying they deliberately ignored obvious red flags. And strict data privacy laws mean every piece of digital evidence has to have a perfect chain of custody, so it's guaranteed to hold up in court. But here's the thing. This is a field that is always, always changing, because just as the investigators get smarter and their tools get more powerful, you'd better believe the criminals are doing the same. This cat-and-mouse game is already moving into a brand new, even more complicated frontier. I mean, think about it. The digital detectives of tomorrow are going to be facing a serious arms race. They'll have to figure out how to spot fraud that was designed not by a person, but by another AI. They'll have to find ways to trace supposedly untraceable assets through the maze of crypto blockchains. And they're going to have to do all of this while trying to navigate a crazy spiderweb of conflicting laws all around the world. At the end of the day, this is really what it all comes down to. In a world that is just drowning in data, this whole field gives us the tools and, more importantly, the mindset to cut right through all that noise, all that fog, and find what's real. It's about turning chaos into clarity. And that kind of leaves us with one final thought. As our whole financial world gets more digital, more abstract, more complex, that line between what's real and what's just an illusion gets blurrier every single day. So in this new world of digital smoke and mirrors, the role of the digital detective, the person who can actually find the fire, has never, ever been more important.